Good afternoon and welcome to this program on ICAI Valuation Standards 2018 and guidelines on disclaimers, caveats and limitations in the valuation report. Well, this program is organized by the Corporate Law, Corporate Governance Committee Valuation Standard Board and is a run-up to the Azadi Ka Amrit Mahotsav of our country. The conception of freedom, whichever constitution which we talk about, American Constitution, or let's come to the Indian Constitution. Article 19, various types of freedoms are defined. Article 21, right to life and liberty. Now, what all it has to do, the conception of freedom and liberty to the economic freedom. We have adopted the model of laissez-faire, least intervention by the regulator, unless until wherein such interventionist measures are required. Now, with that approach being the model for economic growth, the things have changed and various acts and reenactments, regulations and codes have been brought in. Now, valuation as a field is not new. It existed, and whether it was to be required to see the value of an ongoing concern or the liquidation value, or whether somebody wanted a bank loan or financial restructuring exercise or for payment of stamp duties. In fact, there are many enactments, RBI Act, talking about the requirement of valuation in case the shares are to be transferred or to be bought by the foreign individual investors. New enactments like IRDAI or the intellectual property things talking about the valuation of intangibles. So the field always existed. Only thing is that the domain has changed from an avocation to a regulated profession. And we had the Companies Act Section 247, which defined the contours of the profession of registered valuer. And along with it came the IBC code and the registered valuer and valuation rules. So the three put together have laid down the ecosystem of the regulated profession of the registered valuers. Now, let me touch upon the difference between a general avocation or a profession and a regulated profession. If somebody is a regulated profession, then there are requirements of qualification, licensing, and technical standards and being subjected to discipline. And discipline not by mere action of a misfeasance or malfeasance arising out of a consumer action, but as a disciplinary action arising out of the relevant prescribed rules. Now, if we see the registered valuer and valuation rules, I think the ecosystem is quite comprehensive. They lay down what has to be the qualification, how the registration has to be done, and the terms like fit and proper, due diligence. So all these things have come into the regulated profession of the registered valuers. And the three codes and rules and enactment put together, they talk about the impartiality of the due diligence exercise, the true and fair valuation of the assets. And let's look at the deterrence aspect of the law, the Section 247. The subsection 3 says that if there are contravention, then there is an element of pecuniary liability to the registered valuer. And if it is coupled with proven misfeasance and malfeasance, then yes, recovery proceedings, element of incarceration in addition to the pecuniary liability, that also comes into play. Now, as a regulated profession, the standards are meant to provide for an orderly growth. Because valuation is not a mere value, but a narrative, a story, which goes into building a particular what do you call, when you are trying to assess the value of something. And the way various merger acquisitions, they are taking place in terms of horizontal and integration of vertical businesses. So it can be linked to what in science, rather there is a theory of creative destruction by Schumpeter, which says that the old things have to pave way for the new ones. And that's what the entire ecosystem is talking about. Now, once we talk about valuation, it's not a rent-seeking exercise that a license has been given, but it is subject to review. It is subject to a regulatory oversight. And since it is a public good, you are performing an exercise which is of public interest, because you are not trying to create a new economic value, but underlying value of the asset, plus whatever are the going forward, whatever you can squeeze out, or maybe it is capable to generate. So the Delhi High Court, in the case of Cushman Wakefield versus Union of India, so I think that very beautifully sums up as to what is the expectation of a regulated profession like valuer. So they say that not only the profession is involving sophisticated skills, it needs to have higher degree of integrity, impartiality, and ethics. So I think that sums up what all the valuation profession is all about. Now, if we talk in terms of a conduct, a professional conduct, it is in consonance with the standards which are there. Now, standards are in public interest. Standards have been defined to bring in uniformity, transparency, predictability, and a better regulation for the regulators. Now, why this field is becoming important? Because very difficult to identify the intrinsic value. And if we look at the various cases, 17th century, the tulip bubble case versus onion, that's a case of Netherlands. There is a classic book on extraordinary delusions and madness of crowds. That's a 1841 story. So they all talk about that since the intrinsic value of the asset is not known, so any erroneous assumptions would result into bubble and burst, and these valuations are going to be away from the demand and supply curve alone, because while there could be endogenous variables on which the valuer may be relying, which are integral to the system itself, but mostly it's the exogenous variables, the outside parameters, which affect the computation of the valuation of the asset, liability, or the net worth. Now, in all that sense, the registered valuers and valuation rules, what they try to deal with, they have defined an ecosystem as to how the valuation should be carried out. So not only we are trying to cover what is the asset, what is the bank account information, what premise on which we are trying to value, what is going to be the methodology, who are going to be the intended users. But it also talks about the informations, significant assumptions, limitations in taking out those informations, and any caveats, limitations, and disclosures which have been formed by the valuer while coming out with the valuation report. Now, all these three terms may seem to be looking alike, but caveation is caution. Disclaimer is you are trying to repudiate, and limitations, the restraints. So with these, I think with these three words, plus the way you are trying to see the intrinsic value of an asset, because not only you are trying to see the physical assets, the financial information, but going forward, even the intangibles. So the challenges are there, though the ecosystem may seem to be complete. The jurisprudence of the strategic financial assets under the Companies Act, IBC code is yet evolving, and there are many challenges. So I think we have a very learned panel today. I welcome CA MP Vijay Kumar, the Vice Chairman of the Valuation Standard Board, CA Rajan Vadhavan, in fact, who has also been one of the curators of the guidelines on disclaimers, caveats, and limitations, which was brought by IBBI in 2020, as also the Secretary to Valuation Standard Board, CA Sarika Singhal. So with these words, may I now hand it over to CA MP Vijay Kumar to carry forward the proceedings of this webinar. Thank you.
Thanks, Rakesh. It was a pleasure listening to you as always, and for setting the context so very well for this 2-hour seminar to celebrate Azadi Ka Mahotsav. Thanks, Rajan, for accepting our invite and giving your time for dissemination of knowledge on the topic of valuation, always at the request of the Institute. Greetings to all. Trust all of you are safe and your near and dear ones healthy. Sincere thanks to each of you for having joined us in today's event. Since Rakesh has spoken quite exhaustively on the regulation of the valuation profession, let me now take a little different perspective where I'll take this opportunity to share a few thoughts based on my experience as a consumer of valuation services. I individually am not a registered valuer, but having been a standard setter for valuation for the last 3 years plus, let me share my experience of having interacted with very experienced valuation professionals over time. I'm extremely happy the way the valuation profession is maturing. It is still a nascent profession, and it is imperative to ensure an orderly growth of the profession. Like taxation, valuation has a very high economic impact for several stakeholders. And given that it is highly fact-specific, which involves tons of assumptions, judgments to be made, the competence required for valuation is very, very high. In my experience, many times, there's a highly conservative approach out of fear of going wrong on assumptions. I just need to leave a caveat that while conservatism is required, prudence is required, what is important is to arrive at the fair value, which should neither be conservative nor should be aggressive. And that's a different, that's a very delicate role to play in arriving at that fair value. With Ind AS, financial statements have embraced fair value to a larger extent, while many believe there is high use. In financial statements, except financial instruments, almost all other items are at cost, whether it is property, plant, equipment, inventory, receivables, etc. Even in the case of financial instruments, if they are carried at amortized cost, there again, it's just cost. But one important development which is happening now is the Ind AS 40 on investment property will allow revaluation model few years from now. The Institute has already placed its recommendation before the Ministry of Corporate Affairs. And in due course, maybe effective 2023, the companies would be entitled to value the investment property in their books at fair valuation. So there would be many entities in my interactions who are likely to adopt the fair valuation model for the investment property. And consequently, that's an incremental scope of work. Even with reference to property, plant and equipment, Ind AS 16 allows either cost model or revaluation model, but almost all of us follow the cost model. But I am coming across many conversations where enterprises are actually looking at why not follow the revaluation model, because revaluation model helps the user of financial statements to understand the relevant value of the assets in an organization. And for most organizations, property, plant, equipment is substantial part of the assets. More importantly, it ensures a matching concept where the depreciation is based on today's value, just like all other items of income and expense which are at current price levels. And since you are retaining profits, depreciation is a methodology of retaining profits, you actually tend to retain more profits at today's price level, which will help in replacing the assets, which is key for capital maintenance. Today, as far as IBC assignments are concerned, they warrant a huge amount of valuation, and the valuation in these cases often is very challenging due to limited information. And in that context, today, Rajan's moderated panel will give very good insights on how do we address the challenges which come, particularly because of limited information. The valuation profession faces significant challenges as more valuation processes become automated and the role of valuer becomes more of data handling and information processing. With this, the role of valuer must change in order to respond to the industry needs. The role of valuer in particular and how the profession could maintain and increase its relevance and currency has to be examined. My 2 cents is to use technology more for data and value-based judgments. Data with the firm, the valuation firm, and data analytics will be a key differentiator. I strongly recommend embracing digitalization for customer experience, data collection, data analysis, etc. Today, all enterprises and users are digital, and they will have trust and desire to engage only with service providers, including valuers who use and embrace technology start to end. On a different note, most valuations will be subject to test in future, where the regulators will have the benefit of hindsight. Let me repeat. Most valuations which we all do, whether it is for IBC cases or M&A cases, they will all be subject to some scrutiny in future. And when that scrutiny is done, the regulators will invariably have the benefit of hindsight. It is hence important that within valuation firms, we need to have a work environment where the valuation exercise assumptions are challenged and debated. When in doubt, particularly for young valuers, I would recommend to unhesitatingly seek a review by experienced valuers, even if it means sharing a bit of your revenue and earning a lesser net income. Many registered valuers, in my interactions over time, keep asking about the fact that there are limited assignments, and as most valuations are limited to need driven by law. My recommendation is, once a valuer builds a deep expertise of valuation of few sectors, there will be substantial opportunities for valuation consulting. Many organizations will engage valuers to advise on what are the drivers for value creation and how they can be made effective. I see this will be the matured state of the profession. Any profession where work is based only on legal mandate will get commoditized, and there will be no excitement to do work, leave alone money. However, if we as valuers build value to the value creation processes, as we know, ultimately, every business is in existence for value creation and for its stakeholders. Who else other than valuers will be best positioned to offer such consulting? And on a concluding note, I request your active participation in the Institute valuation standard setting process. I believe our standards are second to none, and I have received very constructive feedback on the quality of our standards. ICAI, with the guidance of MCA, Ministry of Corporate Affairs, took the initiative way back in 2018 to draft the valuation standards. I still recall the then discussion that valuation standards globally are not yet evolved, and India has capabilities of standard setting, and that ICAI should take up the project of drafting the valuation standards. Connecting to Atmanirbhar, it gives me personally a lot of happiness that we at ICAI had developed a best-in-class valuation standards. The standard setting was a very robust process, and to date remains one of my best experiences, considering that we received feedback from professionals who are experienced across the world on the quality of standards which we have drafted. I would also encourage all of you to keep accessing our publication of Professional Insight series, which is more about live case studies where valuers have shared their experience on how they have gone about choosing valuation models and how valuations have been done. Request you to use these publications for each of your valuation assignments and also share based on your experience the case study for further publications. I wish an excellent panel discussion and stay safe, stay healthy, stay accountable. Over to you, Rajan, for leading the panel and moderating it over the next 1 hour, 45 minutes. Over to you.
Namaskar. Thank you. It's a pleasure to come for the Azadi Ka Mahotsav functions which we're carrying out at the ICAI. It's always a pleasure, to come and address fellow professionals. And Rakesh ji, MPB, and Sarika, it's always a pleasure to come and talk about this matter. This is something which is very close to me. Valuations, I've been doing them for donkey's years, so it's always very, very nice to come and talk about people. When Rakesh ji rightly said, early 90s M&A activity was very far and few. As there used to be valuation which was done under a formula which was spelled out or laid out by so-called CCI. And then you had the wealth tax valuation. That is what our scope was restricted to. Then came the BIFR, the merger activity moved up a bit. And then we moved into the next stage when the economy opened up much more, that's when the FDI started coming in, the corporates started restructuring, and as more and more transactions started happening, people got into this, valuation did come up. Similarly, then a committee was set up early 2000s to come out with some guidelines. Then you had the Lehman crisis, and various things have happened. And over this timeline, eventually we came to when IBBI took over the cudgels of this thing, and they came out with the concept of a registered value. Prior to that, the Companies Act did give us relative freedom that in terms it said a chartered accountant having a 15-year experience is good enough to carry out or act as a registered valuer. Now, what has happened, and you rightly said, some restriction and onuses or expectations have also been set on registered valuers. I don't think valuation as a profession is only there for a compliance. And unfortunately, I do, when I talk to a lot of people, I hope it does not develop into a compliance tool only, which is filing with the MCA or ROC or Reserve Bank or any of these things about what a value is. But it is going to be very important going forward. The valuation reports, I see them getting evaluated, analyzed, subject to peer review. More shareholder activism also happening. there will be more and more of questioning about any report. Now, the biggest challenge which is going to come up is going to be coming up on account of this fact that everything is going to be looked at in the hindsight and not taking into account the facts and circumstances which were available to a valuer when he would have performed his or her job. And so you will see increasingly more and more litigation happening around it. Hence, the importance of caveats, limitation, disclaimers will come into play going forward. Especially with more and more shareholder activism happening, you are seeing a number of cases where shareholders are raising a lot of these issues. Similarly, you're seeing a lot of regulators raising issues around the evaluation which has been carried out by a particular person. And that's where we see more and more scrutiny happening. Actually, I think when the NPAs, the real number or the amount of NPA when it came out and when it hit the regulators in the country, and they realized that to what extent the damage is there on account of these NPAs, that is when they started the focus on the IBC came out, and as a result, corollary to that was the valuation. And that's when the concept of registered valuer was introduced. So the profession has evolved. It's going to be evolving going forward also. And MPV, like rightly you said, I totally agree with you. Data crunching, data analytics is going to become very important in this profession going forward. Second thing on this is you will see what we call value creation will become a very important thing. Corporates will be coming to valuers. What is a value creation without a valuer being there, right? Now, as a valuer, you've been doing number crunching, so it's very easy for you to identify the levers. Any rechanging of any of that lever, readjustment of that, what can create or enhance value to a corporate or to a business. So this is a logical step going forward, which should happen. And I expect that to happen. Clients will increasingly be asking you, if my X was to change by so much, what will be the impact on the value? So you will see that development happening, that evolution is already on its way. But coming back to the core thing now, that is value creation is a consulting kind of an engagement, whereas when you perform a valuation and you're giving a report to a regulator or a client, and it's an expression of an opinion, and that's where the importance of caveats, limitation, and disclaimers comes into account or comes to our help. Now, why or what has happened, right? At the end of it, what necessitated this thing about why guidelines came into play about a valuer or a registered valuer and why should be done? One was obviously the NPA thing which had happened. The integrity of valuation itself was getting questioned. While it's a very old profession, right? But there were a lot of caveats which were being put up. You had the same asset which is getting valued on the basis of the same set of facts. The numbers were coming out at a huge divergence. People were not, and somewhere that's where I think a very important thing is there was a lack of awareness, even amongst the users, on what what is the purpose of valuation, and that actually created this thing about that the necessity of the valuation regulation to came into play into this thing. Now I will basically now put up some couple of slides which I'll run through on the caveats, limitation, and disclaimers around that. And I'll basically be running through the need, why it came into play, what we should be taking. The guidelines are already there now in the public domain. I think there may be some updations also happening from IBBI going forward on it. Let's see how it works. But I feel we did put in a lot of effort, and what has come out is very good, especially keeping and I'll keep it in the two contexts. One is relevance for us as a profession. Second is it does take into account the local situation and keeping those aspects in mind. These guidelines have been developed or which were put out. Is my screen visible? Is the presentation visible?
Yes, sir.
Yes, it is.
Okay, great. So then I'll just go on to this thing. So like I said, what is the need? The need came in basically coming from the integrity of valuation, which was getting questioned. You had two valuers performing the valuation of the same asset, you're coming up with different value. People were not able to comprehend that there could be the difference in the purpose of valuation. I do recollect the moment I picked up the first IBC engagements, the question which came up was, you are giving us a value of 40% vis-a-vis a valuation which was done by someone else 6 months back. That was a question that the COC asked me, and other valuers asked this question. Well, I said, first is let's be clear, what is the purpose of valuation? That valuation may have been carried out, which was carried out on a going concern basis. And here you have a situation that I am valuing you, what will you get if this company was to be liquidated, to set a threshold or the floor above which the value should be. So, those subtleties had to be brought out first, and that's where the regulation of valuation and all those stuffs were coming in. And there is a huge amount of or onus or liability or responsibility that I would say has been put on a valuer. Hence, IBBI also said that we realize that valuer is performing his job using some information and some this thing. So he should be permitted to put some disclaimers, caveats, or limitation that's necessary. However, the most important thing is they said that the valuer cannot shirk away or walk away with his responsibility. The second thing about the caveats and limitation or disclaimers is the user of the resource and the report. And MPV, you rightly said you are a user, right? You would like to know what are the limitations or disclaimers which a valuer is putting in his report so that you can take a judicious decision on the basis of that report. And the caveats limitation should not be as blatant as saying that I've taken everything what the management told me and I've done that and here is my report on that basis. The user would like to know what procedures, what was the sources of information which you used, what procedures did you perform on it, and then what limitations did you have that you could not complete your work fully, or what your analysis or your opinion is. It is subject to what kind of limitations. So this is the basic idea around why the disclaimers, caveats, or limitations are a necessity. See, the terms have different meanings for everyone, however they can be used one for the other depending on who the user or who's the author is, right? Limitation is good for me as a valuer when I'm issuing out a report. However, for a user or a recipient of the report, it's also a caveat in the sense he knows that under what limitation or under what constraints has this job been carried out. Similarly, disclaimers clearly define to whom I may owe my duty of care or responsibility to. So these terms are used interchangeably. However, one does need to keep in account they can be used interchangeably. They are for the protection of different person or giving a warning or a flag out to everyone that please read this. My work has been carried out subject to this, and hence when you're taking a decision, keep all these aspects in mind. If you want any more clarification, please reach out to me. Seek those clarifications if someone wants to. However, it also spells out to whom do I owe my duty of care to. Eventually, I owe my duty of care to a client, and it should not be that a third party is holding me responsible. Although over here, let me put a caveat that you will have a situation with the shareholder activism, where the minority shareholders, where the regulators are looking at things in a different manner. You will get a question mark, or you will get letters from various regulators seeking clarifications. Hence, the importance of these three terms come into play. One. Second is the importance of your report comes into play. Thirdly is importance of the working papers or the backups, which have prompted you or enabled you to form an opinion or in your report. Maintaining the sanctity or maintaining those papers becomes very, very important, especially why a particular call has been taken. Is there a logical this thing? We all know valuation is an art as well as a science, right? It's science in terms of the methodologies are well laid out, but the art is the application of those methodologies. And that's where the most challenges happen. Valuation will be subjective, but based on the same set of facts, the value can be in quite close proximity, and if the purpose of the valuation is the same. So it cannot be that one person, you want to go and buy a house at a corner plot. Yes, you may ascribe a different value to it. Another person may ascribe a different value to it, taking into account some more this thing. And value and price, these are two different terms. So we are all very aware of that. And when you put a price there can be divergent opinions, but then the divergence cannot be so huge, which is far away from reality or what other things are being others are ascribing to it. Important thing, and this happens, and especially in today's scenario, this would happen is you are having a situation where the markets are changing virtually over the last 2 months, or if you look at it over the last 1 year or so, the markets are nearly doubled. So one does need to factor that, all those aspects when his or her analysis, when a person is carrying out a valuation. There is a logic or rationality around it, which can easily be in terms of there is so much of liquidity which is available in the system right now, which is driving up the asset values. And that's where care needs to be taken, as that what Rakeshji said about that we don't end up in a tulip boom bust situation of the Netherlands, which happened. However, it's like valuation is always performed at a particular point of time, taking into account the facts which are available with you at that point of time. And hence, I would say that maintain good working papers, whatever calls are being taken, keep adequate backups of that, and make a very robust report, and which outlines all the key things which you've done, as well as adequately spells out what the caveats, limitation, or disclaimers are, or which you would like to highlight. So valuations, as like rightly said, we use it for different. It is required. It could be required for various purposes.
You make it full screen, your presentation.
Sorry?
Can you make your presentation full screen?
I'll do that. Is it okay?
Yeah. Yes, sir.
Okay. So I'm saying, so one does need to clearly lay out or spell out the purpose of valuation in his report, so that it also sets out that what has been your purpose of valuation and to whom do you owe your duty of care. That is why it is essential that this is laid out in the beginning itself. Like I said, why all this issue around registered valuer as a profession and concept came into play. Public concern happened on valuation. Fund providers were raising queries. Fund regulators were raising queries. Banks were concerned with the sharp dip in valuation of stressed companies. Well, there were huge variations in the valuation performed by two individuals or two valuers. And there were questions around, resolution applications. The bids which were coming, they were coming in at a different value vis-a-vis the value which a value was putting in. So, what the question mark which happened around this was that the need for the regulation of this business became very important. So the key thing which came out was that each report should be comprehensive, fully reasoned, capable of being tested, and legal evidence in a judicial proceedings. That was a guideline or the underlying principle which was put out or set out in place that for the valuation reports, and hence the need for the caveats, disclaimers, and limitations also came into play from there. Now, typically, as if one was to go into those guidelines, it also spells out what are the good facts of a valuation report. That's where we talk about basically the background. There should be a background. What is the context? Why the valuation? What is the ownership structure? What is the premise of value? Going concern, liquidation, is it required under a statute? And that's where, like a lot of us friends, the fellow professionals, when you're doing a valuation for an income tax, that may not be a fair value, although it may be a fair value under the tax laws only. Because it's a very formula-driven kind of this thing where you're not doing much. It is similar to what we had as CCI formula or CCI guidelines some years back. The formula prescribed how a value of a particular asset is going to. So hence that this thing. So your report should be very clear on these things. The purpose of valuation, who's appointed you, that should be clearly spelled out. FEMA, income tax, what are you doing? The other key thing is over here is identity of the valuer or the other experts who have been involved in this job. And this is one area where I would just like to spend some more time. And this has come up in the peer reviews and the reports when we looked at, and it's a finding, it's been put up also on the website over there. A lot of time it has been noticed the names of the team members or the people who performed the valuation, they were not spelled out in the valuation report. I think it's a must that should be given out over there. The other important thing is, and especially this is much more relevant for securities and financial assets when we evaluate the same, that if you as a part of that process you are relying or you're using or the work which has been performed by, say, a tangible asset valuers, land and building, or any of those persons, you are mentioning or you are reviewing that person's report also. Hence, I urge all of you to do read, while they are not relevant, do read the caveats, limitations which any of those tangible asset valuers can uses in his report. You eventually are relying on his work, and the IBBI and all the regulators are very clear that the person who's finally putting his stamp or signature on the report is answerable for the report. So as a user of your report can question you or ask you relevant questions, you should also be, as a user of that other expert's report, question him or ask him why a certain piece has been done or not done. You need to mention that. You need to be comfortable with that person's report, what he's done, and then include it into your report. And hence, because eventually the final responsibility lies with the person who signed up on the report. He is the one who has to defend that report under law, or if it is put up to question, or any regulator raises any queries around it. Rakeshji talked about, and MPV also talked about, as the profession has improved, this is something very important, and I think it's very important that something like this is disclosed in the valuation report, which is around valuer's interest, conflict, if he's performed any job or he's been associated as a valuer. Well, the law, IBBI, under the registered valuer, this thing has already laid out that certain kind of people cannot be appointed as a valuer for carrying out an engagement. If a person being associated with the company or its associates and all that. Date of appointment, valuation date, date of report, again, become very important because, like I said, valuation is performed on a particular date, taking into account the facts as on that date. To give you an example, numerous times you could be doing engagements, say with keeping a valuation date of 31st March. However, you're signing off the report, say today, which is nearly 5 months down the line. Now comes a critical question that should you factor in 5 month period or items which have happened during that period? Well, if you were performing a CF anyway, that and this has been working in normal course, fine. You mean that aspect would have got covered. However, if you do need to keep in mind a factor like suppose there were flash floods, a plant does not exist today. In this 5 months, that plant manufacturing facility has been washed away. Now I do need to take cognizance of that thing. I cannot say that the value of that thing is so much. It was on that date so much. However, there's a significant event which has happened when I'm signing off my report during this period, which I need to factor. So those things you need to keep in mind. Sources of information again become very critical, and that's where I urge you. You should look at what data analytics which you can perform on the basis of whether it's Capital IQ, Bloomberg, or Capital Line. Even if you're using any of these stock exchange or a Yahoo Finance, get the data from there. Put that source in your report wherever you got that data from. Save a screenshot of it. Keep it in your working paper file. Subsequently, you also need to, but the important thing is when you're taking the data and you're putting a source, but just apply your mind onto it and just take a look at it, that it is not throwing a very distorted picture or something. There is something apparently wrong with that data. While you're not able to correct it, but you may like to dig a bit deeper into those things to ensure that you've not missed out some things. Then the next is, again, like I said, the procedures which you perform on the data or the sources of information to carry out a valuation. I think that's a very important thing which you should have. Intended users, this is very critical in terms of, what caveat you're putting in, to whom do you owe your duty of care, or is that report to be used for a specified purposes? There have been number of litigations where a report was done for X purpose, but was used by the client for Y purpose, and the value has been questioned. There are n number of instances where, say, your report has been used for raising, well, it was for internal decision making, it was never meant for that, but it has been given to a banker to take loans. Now that does result in a tricky situation for you, because if the bankers relied on that report without, but if you articulated it clearly in the report that this report is not meant for any of this purpose, then tomorrow, even if the banker is raising any question to you, you can very well try to get out of it by saying that, yes, that was never meant for this purpose, and neither do I owe any duty of care to you. So hence, it is important that you put all those facts into your report. Restriction on use, major assumptions, factors which have influenced the valuation is again a very, very important thing, because that is what is basically, as a lot of you may have heard, Ashwath Damodaran may have attended some of his sessions. He clearly says, valuation, while you put out a number, that's one crunching number exercise of it. The second is the art of storytelling, or what makes you believe that this number's achievability and all those facts are there correct. or what is tilting your judgment towards something. That should be very clearly articulated in your report, because that is what will come to help you. And it's like, sometimes the client comes and says, "Ye valuation till today he was manufacturing soaps, but tomorrow going forward in his and he was growing at 5%. Tomorrow he comes up with something, I'll be growing at 40% a year on year. And why? Oh, I've also started investing in stock markets, and the returns over there are so much." What are you? The core business is manufacturing soaps and not playing in the stock market. So what are you doing around that? So those are key things which you should keep in mind when you're performing procedures on the data which has been given to you. Conclusions, again, what are you ascribing the value to the equity, to the shares, to the enterprise, to a particular business? I think that is again something which you should clearly articulate in your report. Again, now coming on to the key thing which we've been talking about, what should be the caveats, limitation, or disclaimers? They should be clearly spelled out, because they eventually are what will come to save you in certain situations. Caveats like warning or caution to the client or the service user. It specify also the rights and obligations of the service provider and the third party, and shall not deny the duty of care. To whom do you owe the duty of care? That is the thing. Typically, like what we do, right, in any valuation, we perform following procedures, and that is where the importance of these procedures or putting up these out in the report becomes very, very critical, which is review of past financials, projections, what work you performed over there, how the industry faring up, SWOT analysis, comparison with similar transactions, similar listed companies, discussion, did you do that? Sometimes it happens is, and this is where a limitation comes into play, you may not have access to the management at all, right? You could be doing it on the basis someone owns only 100 shares in an unlisted company, only gets a balance sheet at the end of the year. Now, he will not have any access to the management, future projections, everything is not available. So you should clearly set those things out as limitations in your report. When you're performing the job, this is subject to this thing. He doesn't have any rights in this thing, so I'm performing my valuation basis this, what is there with me. That is very, very critical, and I think that is something which one should keep in mind when he is putting all those things in the report. There, in the guidelines, there is a clear thing set out, an affirmative statement on information and assumptions provided, appropriately they have been reviewed and inquiries made, and adequacy of information and time for carrying out the valuation was right. Is there any issues around that? That should be clearly spelled out, because the guidelines are asking for an affirmative statement around those things. Now, that goes out into a question, does one need to give an affirmative statement or only point out a deviation around this? It is something which is open-ended. Typically, in my experience, I've just been putting out what all I've got, what all procedures I've done on this thing. So whatever changes which I've done or whatever analysis which I've done on it is clearly spelled out in the report. Again, size, key factors which can have an immaterial impact on the valuation, they should clearly be set out a number of times. This especially happens with respect to minority shareholders. Class A, Class C, Class E, what rights and obligations does it have? What are you valuing? Are you valuing the equity of the company in entirety? Post-dilution, pre-dilution, but the rights of each shareholders can be different, and hence they need to be factored in when you're doing this valuation. So what asset is being valued, that should clearly come out as in your report. Like I said, coming on to this thing, what is a caveat? Caveats are warnings to the client or user of services. Limitation and restriction. Disclaimer statement to specify scope and rights and obligation of parties. Those are the key things which one does keep in. And however, the guidelines are very clear that the guidelines are quite clear that the registered valuer cannot disclaim liability for his expertise or deny duty of due care. RVs providing disclaimers in valuation report need to consider the following: rights to be protected, areas subject to liability, clarify content of report, pertains to specific use, caution readers for specific risk. So that is the overall framework on which the caveats, limitations, and disclaimers have been developed, and the guidelines have been put out thereafter. So the guidelines are quite clear. Like they specify what are applicable to all asset class, and then what are specific to a particular asset class, like purpose and use and all that. That is specific. That is applicable to all asset types. Responsibility of RV, like I said, and I've been repeating it again and again, is there to everyone, irrespective of this thing. However, the responsibility of the liability is to which client and no third party, whether that's come out or no. No liability in the case of fraud or misrepresentation by the client. That's clearly spelled out and agreed out also in the guidelines. Similarly, for accuracy of information, the guidelines accept that a valuer is turning out an engagement in a very short span of time. He's not an auditor. He's not providing an opinion or an assurance on the accuracy of information on the basis of which he's performed his job. In case tomorrow there is a mistake, or there is an error, or the wrong data has been provided to you by the client, the valuer cannot be held liable if he has clearly articulated all those aspects in his report. So hence, that's where the caveats or limitations or disclaimers come to help you. Similarly, with respect to achievability of forecast, right? You cannot provide an assurance to what the forecast the management has given. You can only perform procedures on the management provided forecast, because forecasts are dependent on actions or plans which the management is going to be doing. You as an external person don't have a say on those on the management actions or plans in that sense. So you can only review them, analyze them, critique them, question them. But please, for God's sake, do not accept them blindly. There is no guarantee which you can give as an external person that whatever has been shown to you by the management will be achieved, or actual results will be shall correspond to what has been given to you. And this is what MPV and others were talking about. When your valuation is going to come up for scrutiny, there'll be hindsight, benefit of hindsight. Someone will say, no, but at that time you were thinking that my business will grow at 20%. However, it has actually grown at only 10%. The projections were aggressive. Those projections or those plans may have been prepared pre-COVID, right? You never dreamt of COVID will come in. And that's what it was based, that was accepted at the board level and everything. And the business was prepared on that basis. However, something else has happened which may distort or change the actuals. So these are certain very important things which one does need to keep in mind, and hence a caveat, limitation, or disclaimer around this is very important. Post-valuation date events, again, like I talked about, if a plant has got washed away, now what do I do? How do I take it into account or no? I think we should be, and those are certain things which should clearly be spelled out in the report. Valuation, again, barring for a particular purpose, which is for a tax or RBI, where they ask for a single point reference, you usually express your opinion in a range. And that's perfectly fine, because that is the way it should be. There's no mathematical, it's not like a simple formula. There can be things which which may act, everything else remaining same, or certain factors changing, then what could be analysis, what could be an impact on value. And that's where the valuation needs to be expressed in a range, and that should clearly be articulated out in the report. Again, very important caveat or disclaimer around this is the actual transaction value can be totally different from the value which a valuer may ascribe. The reasons are twofold on this. Both the buyer and the seller there could be impact of negotiation, there could be impact of synergies, there could be many other factors independent of the fair valuation which you've done, which can influence a person's willingness to pay either a higher price or someone's willingness to sell at a lower price. Let's take the example. If someone is starved, he may sell the business at a discount. Also, suppose the money was to come in early, but there could be a situation where a buyer, he could be willing to pay a premium over the fair value because he thinks that there will be some synergy benefits which he can gain by virtue of buying this business. So there's a balancing which needs to happen, and hence, like what we clearly say, that the actual price can be at a variance to the valuation which may be performed by a valuer. Reliance, again, the data has been provided by the client. We do accept that to be true and fair, or true and correct in some form or the other. We should clearly highlight that we've not performed any audit process on it. Yes, though one cannot get away with saying that if he did not reconcile the data which he got from the data which is there in the published accounts, then there is some, you cannot just blindly accept that data. You should have some sort of base fact checking and then doing it. Again, a question mark, no procedure adopted to check accuracy of data from reliable external source. I said, and I talked about it earlier. If you are using data from any other database, please look at it. You're doing an industry multiple or industry analysis. There are outliers which are being thrown up. Please look at the possible reason which could be there, which could be responsible for those outliers. It is quite possible some you may or the data for all the companies has not come in. That is the quarterly results. It can sometimes be business has been consolidated. Some results are consolidated, some are not. So one should just not blindly accept the data which is being thrown up by the various databases. In case, one should perform a smell test and see that the data is seeming consistent. Otherwise, you can't take a shelter or this thing that this data I relied blindly on it. If a counter to that was there, that this error or mistake was readily could readily be found out. Compliance with relevant laws assumes that we always assume that the business is complying with various laws. So that's a caveat which does one keep into mind. Now this becomes especially relevant. Let's take an example. You are looking at a business which could be extremely pollution or polluting business, or may have some hazardous waste to be done. So now one does need to keep in mind that it has the relevant certification in place, because the business could get closed out tomorrow if there was a mishap or an accident over there. So one should keep all those aspects in mind. That have you assumed that this thing is there or not? It's like you're performing valuation of a brand, right? Fine, but is the brand registered in the name of the entity for whom you're performing the brand valuation? That is something which one should keep in mind. And if you've not done, please disclose all those things out in your report. There are, like I said, there could be various factors which could be influencing the valuation management skill. N number of times we see same industries, company in the same sector, same industry, however, markets attributing a different number onto a particular company vis-a-vis its peers. It could be on account of management capability, competition, yield, the past track record. Today the things which are in vogue are ESG. Any company which is environmental, social, or government, or and all those aspects, it's good on ESG. They are getting re-rated, or they get rated much better than any company which is rated poorly on those factors. There are more fund providers who are willing to chase up assets for companies which are ESG compliant in some form or the other. I think a very important thing which one should keep out in the report is that will you be willing or to appear in the court of law in case your report was to come out or was to be questioned or to be defended? This becomes especially relevant in the case of dispute areas because you may get into an engagement thinking only about that you're supposed to carry out a perform a valuation and not defend that valuation, and your scope and fees are working around anticipation of this thing. If you're going to be going to the court to defend it, I think you should upfront have those kind of caveats in your engagement letter or the report that you're not supposed to be defending this until you agreed on defending it, and for a monetary value around that. Important thing again onto another clause, which is unavailability of information on the valuation date. This is especially important, and we see this happening when we are performing a lot of these insolvency cases where the management is not cooperating, they are not giving you information. Now, how do you perform a valuation? There is severe constraints on you as a valuer, as a professional to perform your job in that situation. And I think that you should bring that out, that you could only get this data and this much is not available or not available. And hence my analysis is subject to this limitation. There is no management. Suppose the management has run away. Now you don't have access to the management. You should clearly point that out or bring that out in your report to save yourself from further questioning, or next time questioning is there. You can always say, look, I did this. I tried to reach out to the management. Management is not accessible. Or I could only get last 2 years audited balance sheet. I could not get any information beyond that. So my work has been performed only within these constraints. The stock records are not available. I tried finding them, but the incumbent management is not giving them. Let's put that out in the report up front. I tried it, but I did not get it. No one can then question you, at least, that why you've not done. I tried it. I'm supposed to perform my job in X, assuming I've even worked out my fee or commercial on that basis, assuming that I'll be required to do this much work. I can't be doing something more around that or asking if the management is not giving you information. You should clearly set this out. And this is especially important for IBC cases where people have been facing numerous challenges on this count. The guidelines also, set out certain caveats, limitation, and disclaimers across all assets which cannot be used. The word is cannot. IBBI is clearly setting out that you cannot say this, that I have blindly accepted the projection given to me by the management. So disclaiming business plan without applying test of reasonability is a no-no. And that's where, like I was saying, what are the key assumptions? आपने किया क्या है? जो data आपको दिया गया, आपने उसके ऊपर कुछ analysis किया. Clearly दिख रहा है, or you can see it for a number of years, that the company has been growing only at 4-5%. How are you expecting this company to grow at 20%? And especially in light of the fact that there has been no capex, there is no capacity augmentation which has happened in the company. How could you blindly accept those numbers? That is what They are saying that in the guidelines it's clearly spelled out that you cannot disclaim business plan without applying the test of reasonability. Not physically verifying tangible assets in a liquidation valuation. It's said there that you cannot say that. Now, this was a challenge, especially which came up during the COVID time. What do you do with this? This is a constraint, and then hence it should be spelled out in your this thing that you could not do it because of the COVID or whatever. That their travel, there was a lockdown in that territory. You could not do that. So hence my report is subject to this limitation. One can perhaps do it later and see the assets exist there or no. What is there? Similarly, whenever you're using the market comparables data without applying a test of reasonability, that's what I spoke about. You do need to exercise your judgment, or you need to do the smell test at least on any data which you are getting or you're using for evaluation, whether it is coming from a various data space sources, whether you're relying on the report of a third party. Qualification, people say that I could not get data on historical. When the historical data is available, or it can easily be arranged, you cannot disclaim that I cannot get this data when it is readily available. A very important, this one is the second last one. N number of times we've seen people writing a disclaimer saying, we've carried out as instructed by management, we've performed the valuation using only X approach. We've not done anything else. It's a strict no-no as per IBBI guidelines and everything. If you perform a valuation using a particular approach while disregarding the other stuff, you have to clearly spell that out. Number of times we've seen that people have writing that as instructed by management, I have performed this valuation using a NAV approach. They are not writing why income approach has not been used, why a market multiples has not been used. It's a must to write why only one reliance has been placed on a particular approach. One can easily write it's an IT company, so income approach is more relevant than the net asset value approach. And hence I've not used it. If for a hospital, one can easily write I've given greater weightage to the multiples because price per bed is a very important indicator vis-a-vis something else. But do you need to spell that out why particular thing has been done and not done by none? Similarly, it's like we've been discussing this. If your report has this thing that you are relying on the work of someone else, you need to verify that, you need to question that person, you need to be comfortable with the numbers which that person has given. Eventually, the responsibility or the rest finally on the person who is putting a signature on the report. You cannot say I blindly relied upon it. There are tomorrow any errors found in that report, eventual answerability lies on you as a valuer. I think next 10-15 minutes, I'll just talk about a few caveats, limitation, disclaimers, and then I think we'll have the floor open for 20-25 minutes. Is that okay? MPV, Sarika, Rakesh?
Yes, sir. 15 minutes will do, sir.
Okay. Yeah. So the guidelines also spell out, the caveats, limitation, disclaimers, which can easily be used. And they're basically coming from what we've been talking earlier, and you can copy them, you can put them into your report, you can use them. The first one talks about analysis of financial information. It is not an audit, and this is a very important thing because we are not performing any audit on any of this any of those the data which has been given to us. We are using that data, we are analyzing that data, we are performing procedures on that data to perform or reach to an opinion or a conclusion of value. So you should clearly use this caveat is helpful in putting that out from that perspective. The important thing, the second caveat talks about, valuation of companies is not a precise science. Like I said, valuation is an art and a science. It's a science in terms of the methodologies which have been spelled out. It's art in terms of how it is applied. And valuation will be subjective exercise of there is no single value even, and that this is a classical example, right? Over here, when a number of listed companies are coming, people give a swap ratio or exchange ratio. What they say, they do not give a fair value. What they say is that the swap ratio is fair. A fairness opinion is given out on the swap ratio. It is perfectly valid. One person may be coming with a value of 5 and 10. So for him, the swap ratio is 1:2. Still, on the other side, someone may come up with a number of 2 and 4. Still, the swap ratio of 1:2 looks right to them. So they could be concluding on that 1:2 ratio. And that's a fairness of the ratio. And this is extremely relevant, especially for any swap ratio engagements which any one of us is doing for a merger or an acquisition happening by way of share issue. Now, important thing on this is this kind of caveat is also relevant if you are doing a valuation for income tax purposes, because over there you will still be giving a single value. And hence, over there, it is very important that you mention in the report that this valuation is being carried out under Rule 11 UA of this purpose and this, and hence I am giving a single point of reference, because it lays out or it spells out the formula that you need to consider this, X, Y, Z things, and before concluding on a value. So that is why these sample caveats are important. I'm moving on to the next one where it talks about, again, I think we spoke about it earlier. This is that the actual selling price or the buying price could be at a variance to the fair value. Again, this is dependent on the negotiation. This is dependent on the motives of the seller or motive of the buyer, because it can result in application of discounts, premiums, synergy benefits, anything. So valuation hence can get influenced, or the price which gets paid could get influenced by this thing. A very, very important thing which and a lot of us as practitioners would have noticed is it typically when you take a look at the data which comes out of Europe or any other countries, when they are valuing anyone, there is a situation where there's usually a huge discount on account of either a minority or illiquidity and all that. However, in a country like India right now, we are having a peculiar situation where minority shareholders, they tend to take question the value which has been offered by a majority, and usually people end up getting a premium to even the price which may ideally would have been a discount situation had it been a US or any other developed country. Now the reasons for that can be very different. One is the activism which is there. Obviously, there are things about the negotiation ability of the buyer or the seller is saying, you can't force me out of it. If you can't force me out of my shares, so I will stay on. Don't take me out. I'm perfectly happy with whatever you are. So the final transaction value can, like I said, the price can be different to the value which a person has done. Item 4, we talked about necessarily based on the prevailing stock market. Now, if someone had valued a company X last July, his value would have been, and he was to value the thing today, the stock markets, I think, would have taken the prices up to maybe doubled. We all know how many challenges a lot of us may have faced during the quarter of June ending or early July, August, when the companies were going in for their board meetings, listed companies, and they had these challenges that the share prices of the companies had fallen below the book value, and everyone had to get impairment testing done. So stock market prices can move up or down. So one should, when he's performing a valuation, typically at least I do is, or one should do is suggestion, observe the prices over a slightly longer horizon rather than on a particular date in this case. Even if you look at some guidelines which are there, whether it's from SEBI or other places, they talk about 14 days, 26 week, and that kind of a data should be used. Perhaps one should even extend it back to a year. But in today's time, the way the markets are behaving, it really is a challenge to use data which is dated in some form. So, like I said, there are, coming on to item number 5, there are various factors which come into play, which change or which can result in a value being of different vis-a-vis the peer, or the value differentiator, I would say, which can be the management capability, rating, expectation on the company, and all that, and that can influence the value. Coming on to this thing, unavailability of information as on valuation date. Please highlight it. I think it's a very important caveat, especially relevant when you're doing IBBI engagement for liquidation value. The management has confirmed there has been, and typically what happens, right? We get pulled in for IBC valuation in the middle of. It is never at a quarter-ending date or annual date. Like, it will not be 31st March. It may not be 30th June, 30th September. You could be appointed on, say, 20th of July. Now, what do I do with that? So, and you may not even get a cut-off balance sheet of 20th of July. But there is a balance sheet of the financials which are last available is 30th June. You use that as a base if it has gone into a public distinct domain. Use that as a base, seek confirmation that nothing material has happened, and then move forward on it for the next 20 days. Try to build that out. At least I can tell you, this is my experience on IBC engagements. Certain things which I did which were out of which was different, or which took me back to my assurance stage, is I did look at the finished stock in terms of the realizations which they've happened subsequent, or the sales which happened vis-a-vis the last cutoff date, to check out whether the stock inventory existed and if it got sold. Similarly, WIP as well as the raw material, I did perform some sort of procedures to ensure that the stuff was lying there, then it got used, or it got converted into finished goods, or whatever it is. Bigger challenges that happened, I faced, have been on stock in transits, on physical verification of some of the tricky stock items. Amount of coal has been lying around. Please see if the valuing that's where different or your questioning or your objectivity and aspects as a professional come into mind. Why is that coal, if it's a steel plant, and why is that coal not being used? That needs to be questioned. So either the grade of the coal could be bad, or it is not of the right, the moisture content is high, so hence it cannot be used in the for manufacturing. And then is that coal really worth, if it is not moving for such a long time, is it worth it? Is the value correct? That is the question which you need to ask on any of those things. Second thing is, again, going back to the stock takes, when we used to check, should dip thing be done to ensure that there is coal actually under that whole mount. It's not that only for 2 feet you've got coal and the rest is all mud or a soil which has been covered with coal. This especially becomes a lot of times relevant for certain industries, like you're looking at rice, and stock of rice is what you're looking at, and whether there is rice actually there or no, whether the bags in the front is there is cotton there or no, and behind that is just layers of shreds or rags which are being kept there. So you do need to exercise some of these things when you're performing any of your engagements under the IBC especially. So please be careful. Like I said, even don't give up on your professional skepticism. While these guidelines are there, you can use them. But when you're performing your engagement, please don't give up your professional skepticism. Objectivity and independence are let go. Any of these aspects should be kept in mind when you're performing any valuation engagements. Again, confirmation of the information which has been provided to you by the client. That's a caveat which is a must. Like I said, the other is any conflict of interest you've had, any disclosures around that which need to be made, those should be brought out. The report is meant for the purposes and for the intended user. That should clearly be set out. It's a very important caveat. The misuse of report is a most important thing, and one as a professional should take cognizance of that. Number of times you have this situation where your reports do get misused. They were not meant for intended recipients, and then we going around in circles trying to find out. Or see, it's not a question about defensibility. It's also about the effort and the hassle which one has to go through to defend oneself. And one can save out a bit more time if he's careful on all these aspects. I'm cognizant of time, so next 5-7 minutes, I'll basically talk about tangible assets, and we as are users of these reports under security and financial analysts, values of securities and financial asset class. It is very important that you question the expert who's prepared those reports when you are relying on his work, because n number of times, and NMP we talked about, we are talking about the accounting standards to come in where investment properties will be fair valued and be put out, will be captured in the balance sheet. Now over there, investment properties as tangible assets, some security, land and building valuers may value that. Now you should be comfortable, or you should have gone through the caveats or limitations that that person has put in his report when you're relying on his report for the balance sheet which you're certifying. You need to be questioning him the same way as if you're doing impairment testing and the data has been given to you by the management for any company for one of its business. So you should be aware what is this caveat about. And that's where you just basically use your experience and read what has been written over there to question that person on his report. Title deeds, legal and other issues if they are there, sketch plans and photographs, were they available? Did he go and actually visit? Because this becomes especially important for our tangible assets. I've seen reports where people have not visited. There have been encroachments which have happened on the land which was there because the mill was lying closed, and encroachments have happened. Local people have taken over that land. Now someone who's going to buy that land, he is going to make an adjustment to the value for all these factors. So you need to be if someone is giving you land and building report or the valuation report for land and building, you should ask some of these questions. Did you physically see? Are there any encroachments which have happened? Were the title deeds available? Any liens on the title deeds? Legal and other issues. Are you aware any litigation going around? What is the circle rate around this thing? These are some of the factors which, 20 questions which one can prepare and ask any valuer of tangible assets and form his judgment, because at the end of it, you are relying on the work which he has done. Latent defects which are affecting a value. Whether there's any warranty which is there, hazardous condition materials. I use that as an example. The business value, it can accuracy of architectural plan. Whether the plans have been approved, whether they are not approved, whether there was, fire extinguisher or the mechanisms to put fire if there was a fire to happen tomorrow. There's a sprinkler system. Did someone go and see that or not? Because let's look at it this way: if there's no fire protection system installed, as a buyer, I may need to install that to protect myself. So it's a cost saving which the seller may have done, but I will need to incur that. So hence I need to factor that thing in my valuation. Continuity of said business, and this is a very interesting one. We have situations, right, where state investment authorities or development agencies, they give land for a business. Now, a number of those leases come with a condition or a caveat that assumes that the entity to whom this land or this thing has been leased out will continue to exist. And they have this clause over there which says that in case this company was to go into a liquidation or cease to be a going concern, this lease would revert back to the authority. Now, in a liquidation valuation, you cannot ascribe a value of a readily marketable asset when you're valuing such kind of land. One does need to take into account that this value could easily become zero or could only become a refund of the lease amount which I have deposited. So you need to ask these questions when you're using any of those reports which a tangible asset value is given. Independent third party, this exists for both of us. Valuation assumptions which have been made, anything which, a lot of people give those assumptions, even in the case of tangible assets. Is it a corner plot, not a corner land area? Access is there or not there? How has that been factored out? Any premiums or discounts placed on any of those parcels of land on account of peculiar factors attributable to that asset? You should question any of those things to this thing. Survey, qualification, environmental contamination issues around any of those assets, investigation on structural if something was done around that. So please just go through this. This thing is the idea is not that we need to be fairly conversant with it. Just go through these guidelines. They spell out certain cases or situations on which you should ask relevant questions to the expert or the land and building asset valuer when you are relying or using his report for your analysis. Tenancy, we said, litigation, encroachments, anything under construction property. This especially is very relevant when you're doing, there's so many of these real estate projects which are into discussions or deliberation for long. How are those getting factored? What procedures have been performed to value those assets? One should be careful about this thing. Some of the disclaimers, again, which have been put out, I think I'll not go through the list or the whole hog of them, but I'll just urge you, just take a look at them. Cash plan, they cover all these things for the tangible assets around this thing. Definition, premise, one can be very careful about all of this. So with this, I think I will end my presentation around that. I would like to talk a bit about the valuation standards, just standards on a generic way, and MPV, please feel free to contribute on this. There is a considerable debate which goes on about what valuation standards to apply, not to be applied, and all that. Taking into account the spirit of Atmanirbhar Bharat, whatever you say, I think the valuation standards which have been developed by ICAI, RBO, and then, or the valuation standard boards of ICAI, they are quite robust. At the end of it, there is nothing called right or wrong about, or something good or bad about a valuation standard. IVS has also issued out something. There are valuation standards issued by regs. There are valuation standards issued out by different bodies all across. Countries do not adopt them blindly. They can be tailor-made, or they could be peculiarities associated with a certain, on account of some regulations or something specific in a country or something of those aspects in mind. So there is nothing like an ideal valuation standard from that perspective. They are kind of a lighthouse, I would say, or the which show that, or throw light or on the way certain things how should be performed, and that is what you need to ensure. Well, for ICAI and the ICAI RBO as well as chartered accountant, for us the standards are mandatory. And what I'm trying to say over here is they are the guiding lights of the principles which one needs to adopt or one needs to ensure or apply when he's performing his or her job as a valuer. And that's where the greatest debate is happening, whether anything is going to get notified or not notified. That's something I'll leave out to the domain of MCA or going forward. But presently, those standards are applicable to us if you're a chartered accountant or a member of ICAI RBO. I think the valuation standard boards is coming out with valuation standards like what MPV said, on covering some other aspects also. The other thing is, I think I will just submit to the valuation standard board is that I think time may be coming that you may need to review the existing standards and bring them up to date, keeping into mind certain aspects like major things which have happened, a COVID or any of those things, how to cover all those things out. With this, I will end my my presentation. I leave it. I'll hand it over to MPV, and then we can go for the questions, if that's okay.
Thanks, Rajan. It was pleasure listening to you as always. And this is the second time I'm listening to you on the same topic, and I stand more enlightened on this. And the fact that you were involved with IBBI in developing these guidelines and sharing your in-person experience has been very, very helpful. So what we will do, Rajan, is we'll check for what are the questions coming from the participants. Maybe Sarika can help us. I'm not finding anything in the chat box.
Can I take up a few questions, sir?
Please, Sarika. Please, yeah. Sarika.
One question is, how do we rely upon data furnished for DCF method in the absence of any reliable scientific backup for the same?
So I will take it up. See, what are we talking about? It's if you're talking about if it's an existing unit or it's an existing business, there will be some history around it. So the projections which are coming to you, suddenly the history will not get washed away or something new will come up. Now, coming into another peculiar situation, and this is especially relevant, right? Relevant for, say, a startup or a new business which has come up, where there is no history or there's no track record. That is when the question comes up about the projection. How do I verify the sanctity of the data which is being given to me or the business plan? And that's where the application of mind does come into play in some form. You need to question that data. Like for a number of startups I've seen, the questioning starts on what is the size of the market, how it has been determined, how and what will result in changing or achieving the numbers which we are talking about. That's how I've questioned them. A classical or a fantastic situation right now can be if one was to look at, we're talking about a Paytm IPO coming in, you had a Zomato, you will have a number of these, the new e-commerce IPOs happening, right? They've been making losses. They will continue to make losses for another 3-4 years. The important thing is now, again, accepting the projection or the number of business amount which they are handling. You will get into the number of transaction, how it's going on the revenue basis, because you are seeing that this change is going to have, will be able to form a judgment or find that their numbers are reasonable or not. The important thing anyway over here is also, while you're looking at a DCF, please also do look at certain transaction relevant which have happened in the market. Like I said, don't anchor yourself only on the DCF. You may need to use a Gordon growth model or extended period growth and all those aspects into account when you perform a DCF, but also look at market transactions which are recent, which have happened recently to form a conclusion of judgment on that. This thing.
Thank you, sir. Can I, next question is, the member wanted to check with us where he can find valuation publications. These are available on ICAI.org page under the tab publication, or you can directly go on Valuation Standards Board page of ICAI, and in the publication tab, you can get all the publications. Or you write us a mail, we will send you the link where all the publications are available. Mail ID is valuationstandards@icai.in. Then next, one of the question is also I can take up. If I am not holding COP, can I become a registered valuer? Yes, if you are in employment, then you cannot become a registered valuer. But if you are in self-practice also, you're not holding COP, but you are in self-practice or consultancy, you can become a registered valuer. Next question is, I think, over to MPV sir. This IVS 230 is on inventory valuation. How it is different from valuation performed in Ind AS 2 for financial reporting. So again, the thin difference between accounting and valuations are.
No, as far as Ind AS is concerned, I think we are valuing essentially from the context of what should I say, fair value less cost to sell. That's a different situation. Whereas when we do the inventory valuation for the purpose of the valuation exercise, it depends on what is the valuation base we are adopting. Sometimes it can be a liquidation basis accounting valuation. So sometimes it can be ongoing concern. So all those are considered in valuation. So to that extent, there is a difference between the two. Yes.
Yeah. Next question is, how do you verify the work of another expert when you are using him or her because you do not have expertise in that area? Rajan sir, over to you from the perspective of valuation standards or companies registered and registered valuer rules 2017, and MPV sir from the perspective of audit accounting standards.
I would just say, like, let's take the example. You're a security and financial assets valuer, right? You give out your report to another user. How does he question you? You should look at it from that perspective, and using the same yardstick is what you should exercise when you're accepting another tangible asset or a land and building valuer's report. You need to ask those questions, and that's the whole idea. When we put out this guidance note, it clearly sets out that these caveats can be used and these cannot be used, and using around those, if you followed my presentation, I raised out some questions, right? Whether there's encroachment, are the title deeds available, is there any hazardous material lying there, did you verify all those? If someone was to ask those 10 or 20 questions to the person who's given you the tangible asset report, I think you can draw comfort from that report and use that report for your analysis. That is the way I would say that, because users of even our report may not be that knowledgeable, right? But they're going to be questioning, or they can raise questions on what is set out in the report and whether the adequate procedures have been followed to perform the job.
Yeah, I think Sarika, from an audit perspective or even from valuation perspective, if I were to take audit, we have a standard like SA 620, which talks about how the auditor goes about relying on the work of an expert. And in the valuation standards itself, we have our valuation standard 201. And in our valuation standard 201, I don't, memory serves me right, maybe para 40 or something. We have some 5-6 paragraphs which actually give guidance on if a valuer has to rely on another expert for him to arrive at a valuation, how does he go about it? How does he get comfort about the competence of the expert? How can he accept the assumptions used by the expert? All that guidance is available in Valuation Standard 201. So I would just like to sum up saying that there is technical guidance. If auditor has to rely on valuer, there is SA 620. If a valuer, he is relying on another expert, that guidance is available in Valuation Standard 201.
Thank you, sir. Sir, Rajan sir, my request to you for giving example. One example you gave of stick checking for making a disclaimer in the valuation report. Like if you have put in a stick for a stock.
No. So like I gave that example with respect to say, I was asked to go to a steel mill and value that thing. And and I had this huge amount or heap of, there was a hill kind of, which had only coal lying there. Now, how do I value it? There is the valuers, the fixed asset valuers or the tangible asset valuers. They have a formula for valuing liquids and any of these things. They use the formula. It's a cylinder and all that stuff. What we learned in geometry when we were doing our 11, 12. So they did that. But the important thing to do is, it is not a situation that the first 3 foot is coal and the rest is all soil or mud in it. So what do? I just ask this guy to insert a stick, which or not. Similarly, if you're doing a rice mill a number of times and this thing comes up, whether the gunny bags are lying there and there are layers and layers of it. Now, how does one verify what is there after the 5 layers of gunny bags? That's where your auditing skills come into play, or your questioning on the audit come into play, that you are going to exercise any of those things is what you need to keep in mind and accept that fact, because 100% verification is not possible, as everyone would agree, neither on a cost benefit analysis basis. So you can only draw comfort. One process which I did was this. Second thing which I did was, okay, please show me the movement records of the coal which has happened, and why has this particular lot not moved at all for so many months or years. It's getting wet, it's not getting used. So is there any issue around that? So you use all those kind of parameters, to supplement the job which you're doing in another way, which is from the accounting records, which you've taken out the data on how much of inventory physically is lying there. You just do a bit more of job before, and this is especially relevant for all these IBC cases. At least that's been my experience on all of them.
Thank you, sir, for this answer. And I would also like to inform the participants there are more than 1,000 participants who are live with us today also on a working day, and the timing is also post lunch. So 2 to 4 is a very difficult or different timing. Thank you so much for being with us. I would also like to inform you that we have all the publications. We have 10 ATQ series available on our ICAI website as well as our RVO website, which is a compilation of the questions raised at VCM's, our VCM Sundays with valuation experts. So you may take reference of those questions and answers ATQ series for getting clarity, what the question or thought which comes to your mind for taking any clarity. So all our publications are also available on our website. Our website, as you are already aware, ICAI.org, you may go under Valuation Standards Board page and you can get it. And also you can get it on ICAI.RVO.in website. So you may refer all the publications. Now I would request Sehgal sir to thank. Also, I would like to thank on behalf of Valuation Standards Board, and we are happy to be part of this initiative, Azadi Ka Amrit Mahotsav, envisaged by the Government of India for celebrating 75 years of India's independence, that the Valuation Standard Board also could contribute to this initiative of the government. And on behalf of Institute of Chartered Accountants of India also, I would like to thank the government for celebrating this. Tomorrow again, we have one webcast on latest amendments in the Companies Act and CSR, which is also part of the 75 years of independence. Thank you so much, everyone. I would request Sehgal sir to also thank everyone, sir.
Thank you, Sarika ji. And first of all, let me thank CA Rajan Vadhavan ji for putting forth so brilliantly and in a very easy language. And you were very clear in bringing out the provisions, bringing out the regulatory perspective. And since you were involved in the preparation of some of the literature also, so I think the viewers were able to get the two-sided view, the panoramic view of what all went into preparation of these guidelines and how in reality and practicality they should be using various aspects. Of course, this Azadi Ka Amrit Mahotsav, we are trying to bring out knowledge dissemination, what the institute, how it is bringing value for not only the members, but the other stakeholders also. So this learning is always an evolving process, and this is an ongoing exercise. So from behalf of the institute and the Valuation Standard Board, thank you so much, Mr. Rajan Vadhavan ji, for your time, for your dedication, and whatever you have been doing for the cause of the members and the contributing to the very initiatives of the VSB. All that is very welcome, and we express our gratitude. And thank you, CMP Vijay Kumar ji, the Vice Chair of the Valuation Standard Board. In fact, you have been steering this Sunday series, and the way you set out the context today, and the use of technology and what are the challenges. In fact, you brought out the perspective of the new paradigm that it is not going to be a commoditized function or just it cannot thrive on the regulatory mandate alone. But the valuer profession has to create value for itself. And all that has to happen by building up trust and relevance in what the valuer does, because they themselves have to act as brand ambassadors going forward when the valuer profession goes beyond the limited mandate of right now the IBC code or the Companies Act, because the other enactments, they provide a big value and the kind of ecosystem we are seeing. So valuation again will remain an enigma. It was an enigma, it will remain an enigma, and it will need hardcore professionals to crack what exactly the conception of value is. So thank you for bringing out the challenges and the path ahead. And thank you, Sarika, for the work done in the committee. And with these words, applaud for the panelists. And thank you so much for all the viewers who joined for this program. Thank you.
Thank you, Rajan sir. Thank you, MPD sir.
Thank you,
Sehgal sir. Thank you all the viewers to be part of this event. Thank you.
Thank you, Rakesh ji. Thank you, Sarika.
Thank you.
Thank you, sir.